go ahead and connect up here, where you're buying a real property, you're selling homes and things like that, and they're going up. I had a situation, a $4 million home, and they bid it up to $4.4 million. That's a 10% increase. That's another $400,000 that they took out of their pocket. Most of these people, though, they're not getting big loans. They're not getting 80% on it because the appraisals won't come in. They're buying it cash. You get the appreciation on that investment property. You also get the income. So one of the things that I look at is you buy a piece of property, it breaks even. Principal, interest, tax, insurance, maintenance, management, association dues, anything else. Whatever the rents are, that it breaks even. After a while, once you paid off the loans, you say, well, that's 30 years from now. Well, it goes by fast, let me tell you. Now you have income coming in. So my question to you is, how many of you are going to rely on Social Security when you retire? Nobody. Well, then you better have a financial plan involved. And when I first heard about 1031s, I took in order to get your broker's license, you have to take investment real property. And I took the class at the college, and I went through 16 weeks of this. And 1031, I went, nah, you can't do that. That's impossible. I had to take the class again because I couldn't get it. It didn't make sense to me, the benefits of the IRC, Internal Revenue Code 1031. But you get your income. And if you need money, you just borrow against the property and the tenants pay it back. So you say, wait, let me get this straight. So you bought $1 million worth of property. It's now worth $2 million. You need some money. You go borrow a couple $100,000. You want to make sure that the principal, interest, tax, insurance, maintenance, management, association dues, and any other expenses are paid for by the rents. That's a break-even piece of property. If you have negative cash flow, that's fine. But you're looking for a break-even piece of property, in my opinion. Whatever you want to do is fine. Whatever your tax person says to do is fine. So you've owned it for a period of time. It's gone up in value. Your rents have gone up. Now you borrow money out of it. What could you, and who pays it back? The tenants. What can I do with that extra $100,000? Buy more real estate, pay off bills, go around the world with a younger friend. I can do anything I want with the money. It's my money. And because it's borrowed money, are you ready for this? It ain't taxable. That means you borrow the money out of these investment properties. They've gone up in value from appreciation, and you're not taxed on the money because you have to pay it back. But who's paying it back? The tenants. Are you getting a handle on this yet? The first time I heard this, I said, no, this is impossible. Are you kidding me? This is not reality. You can't do this. This is not. Yeah, they've been doing it since I first got licensed back in the 70s. So then you pull the ultimate tax coup and you die. So I've depreciated all these. I've done 1031 tax deferred exchange. I've lived off the money from this, never having to pay it back. Tenants pay it back. And then I don't pay back a dime's worth of tax on this. I made several $100,000 in taxes. And upon my death, whoever I give the property to gets an automatic step up in basis. They can sell it the next day and not pay a dime's worth of that deferred taxation. Now, you say, okay, I kind of got a handle on this, Joel. Why would this come about? Because the richest people in the world, well, let's forget about that. The richest people in the United States made their money in real estate. Okay, old money. You say, well, what about this? What about that? Okay, there are new monies coming up all the time. And Elon Musk, Google, things like that. But what do they put their money into? Real estate. So they went to Congress back in the 50s and they said, hey, listen, we want to keep the economy going here. We're just after World War II. We're fighting the Korean situation, police action. We want to keep our economies going. So we need something that says, if we don't take the cash, if we just take the property, sell this one and get a bigger property with the same amount of loan and the same amount of equity or more, we shouldn't have to pay taxes on it because we never got it. And they put together 1031 tax deferred exchanges. And that's where this came from. The people in Congress made their money. They said, let's put this together. And it was voted in by the people. You get all the tax write-offs against your ordinary income. So remember the example I gave you, $1 million worth of property, $700,000 divided by 27.5 years is $25,000 a year that you don't have to pay taxes on. If your income is $25,000 in HEI, you pay no taxes. You say, my income is $100,000. Then you need $4 million worth of real estate. Okay? I'm just telling you. These are the things that when I came up with this, I said, you got to be kidding me. So, I'm young. I didn't have any money. I went to people and I said, hey, I will help you find these pieces of property. I will then manage them and I get a percentage ownership. And whenever you want to sell, I'll tell you what the value is and what we can do with it. And I'll help you with the 1031 tax deferred exchange. I just get to ride along. So instead of taking my commissions, I took ownership in real property. And when they exchanged, I went with them. And my portion of that got bigger and bigger and bigger and bigger. And then they pulled the ultimate tax coup and they passed away. I took my portion, I 1031'd it, and you can do this, into my own properties. This is an amazing tool. And so when I teach the class, and I apologize about this, I teach it from an aspect of, I want you to benefit. God bless your clients. But I want you to benefit from this. I want you to take advantage of this law. And I want you to protect it because of the benefits that it passes on. It makes sure that our economies keep growing because the money that we normally pay in taxes is put back into creating jobs, creating livelihoods for people. So you've gotten the income off of it. So we're not going to rely on Social Security. The properties have paid themselves off, or you can even pay them off early if you're making enough income on them. And then that income, those rents, you take out the taxes, the insurance, the maintenance, the management, association dues, if there's any. The rest of it goes in your pocket. You get to live on it. If you looked at this from an aspect of, okay, I bought $1 million worth of real estate, whatever that is, that's a puny amount now. And it's all paid off and it's got income, apartments or commercial buildings or strip shopping center or whatever. That income, once you take away the payment on the debt, that's going to be about $10,000 a month for each property. $1 million worth of real estate, 10% return, actually it's a 1% return monthly, 12% over a lifetime period of time, just because of appreciation and everything else after you paid the loan off. Well, how are you doing on $10,000 a month? You say, oh, Joel, this will be 20 years from now. I need more than $10,000 a month. Okay, buy more. You say, Joel, I don't have any money. Who do you know that has money that would take advantage of this? Oh, I know a lot of people. Then get going, Hot Rod. Don't just sit around and say, oh, well, I wish this would happen. You got to go out there and talk to people and tell them about this. And then all of a sudden they go, well, I was going to sell and I was going to pay the tax. And I'm going to go over examples. Hang on. I just want to give you the goodies here. And then we'll go over how to talk to your clients and make sure that they understand. And so now I've gotten the income. Now I don't have to rely on Social Security when I retire. Now we're having some shakeups here in the state of California from an aspect of we're a rent control state. However, if you manage it properly, you're still going to be able to make these kinds of returns. Even if it's a 2 or 3% return on your money, you can't get that in a bank. You take $100,000, put it in a CD, you can't get a 3% return on your money, but you can in real estate. Even with COVID and even with people not paying because of the write-offs and the appreciation. People want to live. I'm telling you, when you look at the newspaper and what's going on in the rest of the country, people, even though there's a mass exodus out of California, people still want to live here. So the value, and they're not making any more land, except on the Big Island in Hawaii. So there's going to be demand for this. And you've gotten tax-free money. Now, when I say tax-free, I mean tax-free. Now, if you look in the tax code, and I'm not a tax person, okay, there's over 4,000 pages on our tax code. That's the Paper Reduction Act. Yeah, right. It talks about the word free one time. Has nothing to do with tax deferred exchanges. It uses the word deferred. I'm going to tell you what that is when we get into our example. But if you borrow money out of the property and the tenants pay it back, that's free. And that's the concept I couldn't get. Why are the tenants paying? Because they're paying you the rent. You get the rent, you pay off the mortgage. It didn't come out of my pocket, but if I need money, I can borrow the money out of the property. All right, so too good to be true. Felt like it to be. Let's see how this really works. So you have to have like-kind properties. Okay, so this is the first part of this whole goodie. Investment for investment or income for income. Now, it used to be you could do real or personal. Let me see here if we got something in the chat. Joel, you sound slower and going in and out. Okay. I'm using the same microphone that. Okay, I will work on. Well, I'm yelling like a crazy person, so we'll just have to go through this, and I am recording it, so you will have availability of this at some time in the future. We'll make it available through Downey, and you can listen to it several times over. So income for income, investment for investment. Now, here's what this says. You got an apartment building and it's giving you income. But that's not what you want to do. You want to call it investment. Because, and here's the reason, if you buy an investment property, you can exchange it for another investment property. Investment for investment. Even though it has income, I call it an investment. And I always do that. Whenever I buy a piece of property, I always put in there, this was purchased for an investment. So now here's the kicker. I can exchange the apartment building for raw land. Investment for investment. I can exchange the apartment building for a commercial strip shopping center. Investment for investment. It might have income, but that's not the reason I bought it. I have another job. It's giving me income. This is for investment in the future. So talk to your tax person about that. Now, it used to be you could do real property and personal property. Can't do personal property anymore. I could exchange my Rolls Royce Silver Shadow for a Lamborghini, as long as it's equal to or greater than and mortgage and equity. You can't do that anymore. It's only real property, but it's income for income, investment for investment. So with that in mind, if we go down here and we talk about vacant land could be exchanged for a commercial building. I bought the vacant land for an investment. I've exchanged it into a commercial building that I'm holding for investment. Industrial could be exchanged for residential. Now, not the home I live in. You can't deduct, you can't tax defer that. You can't write the deductions off. You can't, 27 and a half years over the building value. That ain't working, okay? Your personal residence does not qualify for a 1031 tax deferred exchange. Dang. Okay, we're talking about investment properties. So you're not living in this property. You have an industrial property. You want to exchange it for raw land. Perfect. You want to exchange it for an apartment building. Fine. Investment for investment, equal to or greater than in mortgages. That means a loan against the property and equity. Now in California, we use trust deeds. I know, but they call it in our tax code mortgage because most of our law came from the English common law, which came over from England, 1620, and they use mortgages.
In the West Coast, we use trust deeds of trust, because of the Treaty of Guadalupe held
in 1848, when we had to use Spanish law, and Spanish law says trust deeds, three-party debt instrument. We have different rules and regs on our community property, as well as foreclosures, how we do those. So a little bit differently on the West Coast and the East Coast, but they call it mortgages. So it's just talking about the loan on the property. Now, personal property doesn't meet the like kind. So I remember doing, not several, but doing a couple of personal, actually they were vehicles for vehicles. Okay? And they had to meet certain criteria. We had to get it approved by IRS, and it was personal property for personal property. We don't have to worry about that now. Okay? It's out of the law, 1031. All right, so you cannot exchange your personal residence. We talked about that. You can't exchange personal property. We talked about that. You cannot exchange investment property for income property. Now, remember I told you, two types of property, investment for investment, income for income. So if you have called it income property, and now you want to exchange it for raw land or an investment property, something you're calling investment doesn't qualify. However, investment for investment, that always qualifies. That's why anytime I'm going into a piece of property, on all the paperwork, I say this is being purchased for investment. That's what I'm doing. I'm doing
an investment. Yeah, but it's got income. Yeah, but I don't need the income. I have another job. I'm a real estate broker. Okay. So that way, that exchange qualifies under 1031. Okay. So with that mindset, let's take a look at the example. So here's our example. Let's suppose you originally purchased whatever it was, investment or income. I'm going to call it investment property for $500,000. Through the years you've had it, however many years it is, and some people say, well, you have to have it for 1 year. You got to have it for 2 years. No, the tax law doesn't say that. That what they're referring to is if I bought a piece of property today and I exchanged it tomorrow, it might trigger an audit. So if I've done everything properly, there's no taxation on it. So what they say is you should let it, what do they call it? You should leave it alone for a year so that it can mature. I'm just telling you what the law says. The law says you can exchange it for tomorrow. So you got $500,000 and you put in $50,000.
Joel, I'm sorry, this is Jeanette. Joel.
I'm sorry?
We can't hear you at all. I don't know if it's just me. No one else is saying anything, so maybe it's just me. Can you guys put in the chat if you can hear Joel or not?
Let me go ahead and
Oh, there you go. I can hear you
this.
perfect now.
Okay. All right. Good. I unplugged.
Okay, they're saying they can hear, so it just must be me. So I'm sorry to interrupt.
That's okay. That's all right. Please, and let me know if you can't hear or you can't see. Let me know. You know what the deal is that the internet was set up for a certain number of people, a certain number of things going on. With COVID, it's overloaded. It's like the electrical system in Texas. So we're going to have situations where it comes and it goes. So I apologize for that. Mine is high speed. I use light cable. And so I'm going out, coming in as fast as possible. I'm in an industrial area. So, all right, good. Now, let me make sure. Yeah, if you have something, put it in the chat. All right, it keeps going in and out. Good. All right. So $500,000 you originally purchased it for, and you put in $50,000 worth of capital improvements. Now, capital improvement, we have to figure out what the definition of this is. That is not you've repaired the roof. That's a repair, and that's deducted in the year you take it. If you put on a brand new roof, did that increase the value? Yes, then that's a capital improvement. We had a series of 3-bedroom, 1-bath apartments. We added a bathroom, so it made them 3-bedroom, 2-bath apartments. That's a capital improvement. So let's suppose you did $50,000 over the period of time you held it. You held it 5 years, 10 years, whatever amount of time. And you had depreciation. Now remember, you get $25,000 worth of write-offs. So if you take, let's just do that. Let's go here. New share. Let's go into, let's suppose, remember I was telling you about a $100,000 piece of property. If you multiply that by 70%, what that equals is $700,000 percent. Equal signs here. That's the building value that you have. 30% is land. You can't depreciate the land. I love the enthusiasm, but you can't depreciate the land. So I've got $700,000 worth of building I can depreciate over, and right now it's 27 and a half years. Where did they come up with the 27 and a half years? I don't have a clue. I've looked over the testimony when this first came up, and the only thing I can figure out is the Senate wanted 28 years, and the House of Representatives wanted 27. 28, 27, they just split it down the middle, 27 and a half years. So if you take 700 and you divide it, and this is some of the things that I do with my clients just to give them a feel for what's going on here. So 700,000 divided by 27.5, that comes up to, if I divide it equals about $25,000 a year, $25,400 a year. That's the money I don't have to pay tax on. So remember I was telling you about that? If in fact if your income was $25,000 a year in what's called your adjusted gross income, you owned one piece of property worth $1 million. You had $700,000 worth of building value, and this is the building value. Building value, because you can't depreciate land. You divide that by 27 and a half years. That's 25,000. So, and again, this is one of those things where I went, what? And the professor that I was going to Chapman University, he said, how many of those do you need before you don't have to pay taxes on your income? I said, well, if I'm making $100,000, I need 4 of them. And that's where I came up with this. So now, when we're looking at this, if we had, and if we go back to our example, here, share screen. If we go back to our example, minus depreciation, that means I've had this. If we took 25, whatever that amount is during those period of time, and that would be that'd be 6 years. In this particular instance, it'd be more like 12 years. I've had this property for 12 years. I have written off $150,000 worth of depreciation. It's a depreciation deduction. It goes off against my ordinary income. Now, the kicker with this whole thing is you said, you know what, Joel, I hear what you're saying. I'm just going to sell it and take the cash. You're going to have recapture. All of this $150,000 here, you're going to have to pay tax on again. That's what I'll say. You go, what? I know. If you're going to get into this, you need a good tax person, not somebody who does, H&R Block, somebody who understands 1031 tax for exchanges and carry forward and things like that. But for our example, we bought it for $500,000. We put in $50,000 worth of capital improvements. We did the lawn, we did some painting, those are expenses. Those are deducted yearly. And we had $150,000 worth of depreciation. That means our adjusted value will be $400,000. You say, well, what difference does that make? Well, that's what you're going to have to put into the next piece of property in order not to be taxed. And that's why when I looked at this the first time, I said, I was a math science major in high school. I did trig, I did calculus, and I couldn't figure this out. It didn't make sense to me. So if you're looking at this saying, Joel, this makes no sense to me, I understand. It took me I went through 2 semesters of real estate investments to get this, because, some things are common sense and some things are like, are you kidding me? And this is one of those, are you kidding me? You can take this $400,000, sell the property, pay whatever expenses are on the property, and then you could use that money, put it into the next piece of property and start all over again and not pay a dime's worth of tax on the profit. Yep. So second capital. So our sales price is, we bought it for $500,000. We sold it for $1.2 million. Is that unusual in a 12-year period of time? No, it's probably low. We minus the adjusted basis, $400,000, plus cost of sale. Now, I had to pay a commission to sell it. I had to fix it up to sell it. Plus, I have purchase of the new piece of property come up to about $80,000. You say, Joel, that's too high. Okay, whatever that figure is, that's what you put in here. Oh, that's too low. Okay, and increase it. I'm just giving you an example here. That means if you sold the property today, you bought it for $50,000, you adjusted your basis to $400, you bought a new property, or sold it, excuse me, we're not even buying property yet. We sold it for 1.2. You don't have to pay tax on the 400,000. However, or the 80, you're going to pay tax on $720,000. Recapture of 37,000, and this your accountant figures this out. Capital gains federal, if it's 20% still when you do it. Net capital gains 21,000, state of California. That means you're going to have total tax. You bought it for 500,000, you sold it for $1.2 million. You got the cash in your hand after you paid everything off. You're going to have to pay $250,000 in taxes. I don't know about you, but I got better things I can do with that money. And here's what really hit me. I took so let's go back to our example here. Oops. We'll go into share screen. We'll go back to our example. If we took that $500,000, we'll just make it nice round figures. Joel is a product of the LA City School District. Okay, so we need nice round figures for Joel. If we got $250,000 that we were paying in taxes, but we did a 1031 tax deferred exchange, we don't pay any tax on that $250,000. We use it as a down payment. So let's suppose this down payment, this equaled 30%. 30% more down payment. You're exchanging into another piece of property. You're getting more down payment. So you take that $250,000. Let's see here. 250,000, you divide that by 1.3. That means you could buy an additional $800,000 worth of real estate. That equates, if you bought an $833,000 more real estate. If I didn't pay that $250,000 in tax, I could use it to buy more real estate. And that's what they want you to do. They want you to buy more real estate. That means I could let's not put that minus, put equals 30%. It equals another. Okay, so now if we just take that figure, forget all the rest of this whole stuff, just take the $833,000. If that appreciated 2% a year, you didn't pay any tax on you didn't pay the $250,000. You get the appreciation of the new building, and you're not talking about 830. You're talking about a $2 million building here. At 830, you get the additional appreciation. You say, well, it's more like 10%. Well, 10%. That means you're making $83,000 a year on money you should have paid in taxes. Are you getting a handle of this yet? This is why, for me, I looked at this and said, something's wrong here. This can't be for real. And I had to do research on it. And I went to the CAR website and I downloaded. So if we go to the California Association of Realtors website, let me get a new share here. Well, all right, I'll have to bring it up. Let me go ahead and bring it up. We'll go into it in just a minute here. I went into the Q&As, the legal Q&As, and I downloaded the 1031 tax. So I understood the law. Now, this was many moons ago, and the law's changed a little bit. It's included some things and taken away some things, but it's still a viable option. And this is why people say, well, I want to sell my investment property. Terrific. What are you going to go into? What? Well, if you sell it, you'll be taxed. And I show them the example. You're going to be taxed on that. They say, well, I don't want to pay that tax. I say, okay, then what we need to do is we need to find you another piece of property to go into that's equal to or greater than in mortgages and equity. Whatever your mortgage is, you say my mortgage is zero, then we can go into a piece of property that has zero mortgage. But you're going to have to take all of the money that you're making on this and put it into there. You say, but I want some of that money. Okay, once we got the deal done, borrow it. Tax-free. Something coming up a little bit here. Okay. That's why it took me so long to say this is not, something's wrong here. And what was wrong was the people in Washington, D.C. owned a lot of real estate and wanted to take advantage of this and buy and buy and buy and buy and buy, and then leave it to their heirs or errors, as the case may be, this huge profit on this. And they had the money. They just borrowed the money out of it. Tenants paid it back. And the lenders are going to say, wait a minute, you want to borrow money against your investment property, you have to show me how you're going to pay it back. You say, well, here's the income. Here's all the expenses. I have this amount of money left over. I can use that to make mortgage payments. What's your interest rate right now? 5%. We amortize that over a period of time and it pays for it. Give me the cash. Sometimes they want to know what you're going to do with the cash. Other times they couldn't care less. It all depends on the market that we're in. So I'm sitting here with my client and I say, you bought it for 5. it's worth 4 as far as an adjusted cost basis. You're gonna sell it for 1.2. You're gonna pay $254,000 in taxes. They say, how do I get out of that? I'm so glad you asked. So let's go to the next slide here. So the next slide, it says equal to or greater than in equity and loans. Now, I have a loan on the property of $500,000. I will have to go into the new property at a loan of $500,000 or more. Typically what happens is you're buying, you sold it for $1.2 million. You're going to buy a piece of property, say for $2 million. You have a loan on it for $500,000. You're going to go up to maybe $1 million in a loan. You say, wait a minute, Joel, I can't qualify for $1 million. Who's qualifying? The tenants. Are you getting a handle on this? Because that's who's going to pay it back. And whenever you have investment property, they always put in the deed of trust an assignment of rents clause. That means if you stop, the money comes to you as the tenants pay you, you pay the landlord. If you stop making the payments, you're collecting the rents, but you stop making the payments, though the lender has the right to go directly to the tenants and get their money. Call it assignment of rents clause. So even if you stop making the payments, they're going to get paid. They love these kind of loans because the tenants are making the payments. You say, well, they're not making the payments right now. I understand. Okay, but things are going to even out again, and this is still viable, and people are still doing it every day. So loans, then equity. So the amount of the equity. Now, sometimes they say price. I say equity because if you touch any of the equity, in other words, your adjusted cost basis, if you get any of that money in your hand, it's taxable. I just had one the other day. The seller said, look, I want to do a 1031 tax deferred exchange. I want to do it into several pieces of property, and you can do it in several pieces of property now. You could take one big property and put it in several little properties, and then you could sell little properties as you go along here and only pay tax on that little amount that's in there. 1,000 different things you can do with this. But anyway, he wanted to buy, but he said, Joel, I need some cash. I said, just borrow it out. He said, no, I need the cash now. I want to sell it. I want to go into these other properties, but I need some cash out now. I said, okay, then the amount that you're going into, your equity is going to go down. You're taking some equity out. You'll be taxed on just that equity, not on the whole thing. You could have a partially deferred tax. And somebody asked me, well, wait, Joel, I know you're going through this PowerPoint here. Can you send me a copy of the PowerPoint? Absolutely. I'm happy to do that. I want to do that because if you have this, you can look at it several times and maybe say, I think I might have a little bit of it. Okay? Talk to your clients. Example, you got a 10-unit apartment building, it's worth $3 million. With a $2 million loan. You must exchange it for another piece of property that has a $2 million loan on it and is worth at least $3 million because of the equity that you have in there, $3 million. So you say, well, I know about the loan I got on my old property. I'm exchanging into a new property. How do I get a new loan? How did you get the old loan? Oh, I went to the bank. Then go to the bank. Yeah, but the bank says I don't make enough money. Who's paying back the loan? Now, if it's negative cash flow, you're going to have to cover the next negative cash flow. And some lenders will only say, oh, well, your cash flow is $100,000 a year, but we're only going to count 70,000 of it. So you might have a positive cash flow piece of property in order to get the loan. But you're buying more real estate. Remember, I exchanged out of my $3 million, and now I'm getting a $6 million. I know in my example, you're going to have $3 million, $1. But if you go into a bigger piece of property, you're going to have more income. Well, I hope you're getting more income. That's the whole idea behind all this. We're trying to get more income. Oh, you're doing it for free? Okay, after class, talk to me. I'll take care of all the free stuff that you don't want. So what we're doing here is whatever that loan is we're going out of, we have to have a new loan to that amount. And then we have to take all the money that's in there, the equity, and we have to put in new property. Now, remember, we get deductions for sale. We get deductions. So in other words, I'm selling my $3 million piece of property. What does it cost me in commissions and escrow fees? Whatever that is, it lowers that amount so that I don't have to put that much more in. So I have an adjustment. And the example that we had, if we go back here, and the example we had is I sold the property and it's an $80,000 piece of property. $80,000 worth of, excuse me, not property, $80,000 worth of expenses. What do you mean? My commission. That's what I'm talking about, and escrow fees. Okay, that's what I'm talking about, that 80,000. So what that does is I don't have to go into a $3 million. If I go out of a $3 million piece of property and I have $80,000 worth of expenses, I don't have to go into a $3 million piece of property to be tax free or tax deferred. I can go into a $2,920,000 piece of property because of this 80,000. You say, Joel, now I'm really lost. I understand. I'm with you 100%. That's why you want a tax person, and you want to sit down with this. You want to go through several examples with a nice bottle of Chardonnay, because it's one of those things where it just doesn't make sense to me. Okay, but it's done all the time, and I've done many of them personally, and I've done, well, I don't know if I've done hundreds for my clients, and it's just one of those things that they don't want you to know about. You know, it's, you know, they always say, you know, you read the tabloids that are at the grocery store, they don't want you to know about this. Well, they don't want you to know about this because it loses tax money for the government until such time as you sell the property, and then they recoup everything. Well, you pull the ultimate tax coup and you die. You had all the use of the money, all the income, all the write-offs, and when your heirs get it, they get an automatic step up in basis. They can sell it the next day and not pay a dime's worth of tax. At this moment in time, things could change. All right. So greater, equal to or greater than, so our mortgage. So now the next thing is title has to be replaced in the same way as it was held when you relinquish the property. All right. Now they used to be kind of loose on this. Now they've gotten really sticky. If I own it as Mr. and Mrs., and I want to exchange it into another piece of property as ABC Incorporated, they ain't going to go for that. I'm going to have to exchange it into the new property, Mr. and Mrs. And then if I want to put it into ABC later on, once this is all done, that's fine. As far as the tax code goes, however you sold the one property, you're now going into a new piece of property. You have to keep that. That's a biggie. If you use an accommodator, the accommodator will make sure of that. We're going to talk about accommodators here in a few minutes. They are one of those things we didn't need when this first came up. I've done a lot of exchanges. We never had accommodators. What the accommodator does now is it makes sure that there's no hiccups and that the 1031 tax deferred exchange becomes taxable. So we're going to talk about that, and it's we're called a delayed exchange. So, or if you're an LLC or an LLP, you know, it's got to go back in. So a lot of times people say, well, wait a minute. How do I do this? You're going to have to talk to your tax person. I'm just telling you what the law says, and you don't want to mess it up, because if you do and you get audited, the whole thing's taxable. And now you've said, wait a minute, I took all the money, I put it back in there. I don't have the money for the tax. Well, they're going to lien the property and maybe make you sell it, depending on how big it is. All right, now somebody asked, when are we going to take a break? We'll take a break probably, well, let's see what we got going here. Why don't we take a break right now? So I've gotten you, you're like, okay, Joel, I got a little bit of this, but I don't see it. Okay, I'm with you. We're going to go through this. And my old football coach, he used to tell me, Joel, first thing I'm going to do is I'm going to tell you what I'm going to tell you. Then I'm going to tell you. Then I'm going to tell you what I told you. So you're going to get it 3 times. Okay. So what we'll do is we'll take about a 5-minute break. It's 10:51. We'll be back here 10:56. Get up, stretch, run around the room. If you do have any questions, go up, go to where it says chat, check them in there. If you say, Joel, I'd like to talk to you at another time, fine. My telephone number was on the first slide. I'll go ahead and put it back to that first slide so that you can take a look at that. All right, we'll be back here in a few momentos. Talk to you soon. 5 minutes. on a little break here. We'll be back in a couple of minutes. Don't panic. I know you came back to your computer. You're doing something else. You went, what happened? Break time. All right, lots of stuff to cover here if we're going to get out by 4 o'clock. What? No, we'll be long before, we'll be done sometime afternoon. So, and if you have questions, now what I want to do is I want to make sure we've kind of gone over this. So here's how to get in touch with me. And then when I started out in the program, I talked to you about you defer till you sell. Your taxes are deferred, and there's no taxation until you sell, as long as you go under IRC 1031. However, you get the tax benefits, you get the appreciation, you get the income, and if you need money, you just borrow against the property. You say, what if they won't loan me money against the property? Well, then it's probably, if they gave you money, it would be negative cash flow. The lenders are real, if they're going to use the tenant's income as paying the loan, they're real skeptical about giving you cash out that you're going to have to make payments on unless you can make them. So but I will tell you this, depending on your loan to value, there are lenders out there who will make you a loan, hoping you will default and they can foreclose on you. And when they smile, they got little sharp teeth. Okay. What can you do with borrowed money? You can do anything you want, and borrowed money's not taxable. So you pull the ultimate tax cue when you die, it goes to your heirs, they get an automatic step up in basis. You say, I don't know what that is. I understand. Talk to your tax person. Yeah, but my tax person is still beating rocks together to make fire. Need new tax person. Somebody who's familiar with this kind of stuff. Yeah, but they cost a lot of money. Let me think. You're buying real estate. You're getting income, you're getting tax write-offs, so you're not paying. You couldn't take some of the savings from the taxes that you're not paying and pay a little bit more to a better accountant? Juggle this thing out here. And you've gotten all the tax write-offs. Plus, eventually, when you pay down the loans or pay off the loans, you're getting total income. You say, but isn't that income taxable? Gee, many Christmas. I'm giving you all the stuff, and now you're worried about paying some taxes? Yes, it's taxable. Any income that you get is taxable. Well, no, I take it back. If you're a federal employee, there are ways around that. But since most of us are not federal employees, we don't have that. And you've gotten the money tax-free when you borrowed it. And it only shows up one time where it's tax-free, and in the entire 4,000 pages of tax code, and that's under 121 of the IRC, and that's when you do, when you sell a piece of property, you get once in a lifetime, 250,000 individual, 500,000. That is, they actually say tax-free. In the IRS tax code, they say tax deferred, but borrowed money is not taxed. So as far as I'm concerned, it's tax-free. You say, what if I sell the property? Then you'll have recapture. Well, I have to pay taxes on it. Yes, bonehead. You sold the property, you got cash, you're gonna have to pay taxes on it. Okay. You say, well, what if I need the money? Borrow it. Well, what if I don't want problems anymore? Then pay somebody to take care of it for you. No, Joel, I just want my cash. Okay, fine. If you just want the cash, it's no longer too good to be true. You're gonna pay taxes on it. You say, but Joel, I made so much money, I'm happy to pay the taxes. I hear you. There's going to be a point in time where you might say, you know what, I got all these properties, I don't want them anymore. I'm tired of all this monkey business. I just want the cash. Even if you paid 50% taxes, you still got a pot full of money. I'm okay with that. I'm just telling you what the benefits are of this. So like kind is investment for investment. We want to make sure. And vacant land will work for commercial property as long as it was held for investment. If you say, well, income, well, a vacant land doesn't have any income unless it's a parking lot. Okay. If it has no income, you can't exchange it for other income producing property. That's why I call everything investment property, and you just delineate it. When you bought it, why'd you buy it? I bought it for investment. I put it right in the file. I give it to my tax person that way there's no discussion later on. And you can't do your personal, you say, well, I've lived in this house and I've done this. Can I exchange it and not pay? No. It falls under what's called IRC 121. The Internal Revenue Code 121 says you can sell your personal residence and take $250,000 tax-free. That's in the code. Tax-free individually, or $500,000 married filing jointly. You can do that. And Prop 19 made some changes on that. So again, you're going to have to talk to your tax person. Somebody asked me, well, can I use the moving expenses? That's a CPA question, because it didn't have to do, it had to do with you moved from the property or moved something from the property. It was an expense on the property. Can I subtract it from my expenses and not have to pay tax, or can exchange into another piece of property? It's right there on the edge. So you're going to have to talk to a tax person about that. You can't exchange personal property anymore. And investment for income. You have to do investment for investment or income for income. So with the example I gave you, you're sitting down with your client. You say, Joel, I am the client. Good. Then sit down in front of the mirror and have the conversation. I bought it for this, and you just plug in the numbers. I have that much improvements, capital improvements that are depreciated. So what happens is you had the property for 5 years, you put a new roof on it. That's going to be over a 27.5 period of time. So you're going to start depreciating that. I know roofs don't last 27.5 years, but for this example, we'll just keep it easy. And then you had $150,000 worth of depreciation. If you divide that by, say, $15,000 a year, 10 years, you had the property. And then remember, it's 27.5 years for residential, that's apartments, and 39 years for commercial. Why? I don't know. That's just what the numbers are. You say, well, I had properties back in the 80s. We used to depreciate them over a 15-year period of time with accelerated depreciation. Yeah, that was in the 80s. We're now in the soaring 20s, not the roaring 20s, the soaring 20s. Okay, tax law is a little bit different. We then sell the $500,000 property for $1.2 million. We have our minus our net. We don't have to pay taxes on the $400,000. We have $80,000 worth of sales costs, commissions, escrow fees. That means we got $720,000 worth of taxable money. You're going to pay that much. Your free capture is still 25 when you do it. That much if you're in the 20% tax bracket, that much if you're in the net. This is what they call AMT, alternative minimum tax. And then that much for California, you're going to pay $250,000 out of your pocket. You got 720, 254,000 of that is going to go to the government. You say, I don't want to do that. Then you do a 1031 tax deferred exchange, equal to or greater than mortgage as an equity. So the mortgage, whatever that is, whatever you went out of, equal to or greater than, and equity, equal to or greater than. So you could put more money down into it. Okay? It just has to be a higher price then, so that those two equal out. So the example I gave you was $3 million, $2 million loan. You got to get a $2 million loan in the new property, and you have to buy a property that's at least $3 million, $1. Now this is just a simplified example. The reality is, you could buy a property that's cheaper than that. You could do the exchange cheaper than that because of expenses and depreciation. But that's not the idea behind this. The idea behind this is I sold my $3 million property. I got a $6 million property. I got rid of my $2 million loan and got a $3 million loan. Or, I've only got $1 million in there, Joel. Okay, then buy a $4 million property. You exchange out of 3, go into a 4, you put it down, and you get a loan for $300,000. 75% LTV. Just make sure the principal, interest, tax, insurance, maintenance, management, association dues are paid for by the tenants. You say, well, how do I do that? CPA or tax person. Okay. Aren't there programs that'll do this? Absolutely. You can buy a program. You just plug in the figures, it'll do it for you automatically. In the old days, we had to, push buttons real hard to get it to type. Now we can just talk to it. Hey, Google, how much depreciation do I get this year? It tells me. It's like, crying out loud. This makes it too easy. You got to go in with how you went out. So now we do the exchange equation. So for full tax deferral, and this is what I'm talking about here. You say, Joel, I need some cash borrowed afterwards. Oh, I don't need it. I want it now. Okay, then that's a partial exchange, whatever portion. You say, I want to reserve out $100,000. Then you're going to pay tax on the $100,000. The rest will qualify, but it just won't be a full deferral. And unless you need the cash right then, I would suggest do the full deferral and then borrow later on. You're going to have a big equity in there. Now, maybe not the first one, but you move on down. So you invest all net proceeds and you acquire property of the same or greater net. So all the net proceeds, I had this amount of equity, I had this amount of expenses, I have to invest all of that in the new piece of property, and I have to get a loan that's equal to whatever I'm going out of, equal to or larger. And again, the lenders are happy to make you a loan on this. And you say, well, they won't do this with residential. I understand. We're not talking residential here. You can't do residential, your personal residence in a 1031. We're talking about investment properties. So we relinquished a $900,000 piece of property that had a $300,000 debt against it. Just some new numbers here. I just want you to see how these numbers work. You paid $60,000. And I'm going to give you the piece de resistance once we get in a second part of this class. So this is escrow fees. This was title transfer. This was, commissions, 60,000. You say, I can do it for more or less. Fine. I'm just doing an example here. That means your net equity is $540,000. You bought it for your relinquished value is 900. And here's the interesting thing. You put it on the market, you put a for sale sign on it, you advertise it in LoopNet, CoStar, Brev, Provitas, Crexy, RPR, wherever you advertise it. And a buyer comes along and they buy it. You say, whoa, 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 I thought we had to do an exchange. We're going to get to that. Don't get excited. You put it on the market just like you would if you were going to sell it and get the cash. The only caveat is you put in the MLS buyer to cooperate in 1031 tax deferred exchange. And we have forms for that in zip forms, and I'll show you those forms. So we got net equity of 540,000. All right. So now We buy in a replacement property. We went from 900,000 to 1.2. We have debt now. We went out, got a new loan because we only had $540,000 down. We put the down payment. We got a new loan for 660. Did we go equal to or more than mortgages? Yes. Did we go equal to or more than net equity? Yes. We're good to go. And this is what the accommodator and your escrow will do. And you want somebody who's experienced in 1031 tax deferred exchanges. I'm talking from experience here, because if the escrow doesn't understand this, they miss a step, you're going to be taxed. And the last thing you want to do is have the IRS walk in and say, oh, you didn't do it right. It's all taxable. That's why you need a good accommodator. And I'll tell you what those are in just a minute here, because those are, if you don't have an accommodator now, you're playing IRS roulette as opposed to Russian roulette. All right, so then here's what happens. We sold the property for 9. We bought a new property. We exchanged into a property, or bought it. We got a bigger loan. We have no boot. Now, what the heck is boot? Did we have boot in this other deal here? I didn't have any boot here. All of a sudden, we got boot. What the heck is boot? Well, I don't know. I tried to figure out that, I was like, where did this, have you ever thought about where some of the words that we use come from? Enough. E-N-O-U-G-H. Enough. Where did that come from? Oh, some language. Anyway, the closest thing I can figure out, boot is taxable. If you have boot, it's a taxable event. So look, if I didn't put all the $300,000 in there, I said, you know what, I need $100,000. So I put $200,000, or I had a loan of 300, and I only get a loan now of 200,000. For whatever reason, I'd be taxed on that $100,000. That's considered boot. If I didn't put all the money down, I pulled out some of I got a bigger loan, but I pulled out some of the cash. That's boot. Now, the closest thing people say, well, that comes from England. The back of the car is the boot, and that's where you put the money. Nah, I don't think that. See, this is strictly the United States. This is United States law. They don't have anything like this in England. I think there was 2 cowboys. They were trading horses, and the one said, I'll take your horse if you throw in your boots. So that's why they call it boot. Boot is taxable. Anytime you see, if your exchange accommodator says boot, you go, oh, that's taxable. And the other agent says, well, there's going to be some boot, that's taxable. Just think of it that way. Boot equals taxation. So the taxpayer acquires the greater value, invests it all. There's no boot. Boot equals unlike property. Unlike property is cash. Remember, it's got to be investment for investment or income for income. Cash is neither of those. Okay. All right. So let's look at this timeline. And this is how the accommodator, we call them an accommodator. Federal law calls it a qualified intermediary. We call them accommodators. Same. So step 1, you complete the sale of the property. In other words, you put it on the market. Somebody comes along and says, oh, I want to buy your property. You say, perfect. Don't move. We got to make you aware that we're doing a 1031 tax deferred exchange. So let's take a look. Let's go to, I'm going to do a new screen launch here. We're going to go to the California Association of Realtors website. So new screen share, California Association of Realtors website. I'm not sure what the significance is of the person sitting in the chair, but here's what I thought. I thought if you got your picture on the front page of the California Association of Realtors website, you must be a top producer. And I like to deal with top producers. So I'm going to get in touch with Meredith. I'm going to say to her, hey, Meredith, if I have a deal up in Pasadena, I want to send it to you, because I've learned in the short period of time I've been doing this business, you need to be knowledgeable in the area in which you deal. If you're not, shift the risk to somebody who is. So if I'm not familiar with Pasadena, I would contact her. So I said, okay, it says, if you'd like to have your picture taken and put on the front of just fill out an application. All right. So what I did is I went in here to search. Well, no, let's not do search. Well, let's do 1031 search. Since we're doing 1031s, let's take a look and see what information they have available at the California Association of Realtors. This is federal law, so if you go to NAR, they might be able to do a better job for you as to what's available there. There are several question and answers, Q&As that have been put together by our attorneys that actually goes through and talks to you about what's available under the 1031, what you have to do. I don't know why this thing is screen sharing on. Okay, here we go, screen share. So you can look at the Internal Revenue Code and, oh yeah, you got to have a password. Okay. Do we have enough passwords? Okay. And if you need some extras, I got some extras. So let me make sure we're sharing the screen here. So I just went to the California Association of Realtors. Here is, I don't know how many questions. This is member legal services. Remember what I told you? Area code 213-739-8282. This is 800. If you come down here, it talks about question number 1, what is it? Question number 2, what is the exact wording? Question number 3, what are the time frames and a delay? I mean, it goes through everything I'm telling you about in about, well, let me see. I don't know how many questions there are here. It looks like 3 pages, 30 questions. So you got 30 questions here that they answer. This is done by our legal staff in conjunction with the tax ramifications on this. So that's one area. Now, if we go back here and we go to our zip forms. So we go into transactions here and I go into access zip forms, lone wolf zip forms. Oh yeah, that's, this one determines if you paid your if you've paid your dues. I always love that one. You know, you're sitting there in front of your clients, you're trying to get into zip forms, it doesn't come up continue, you haven't paid your dues. That's like, how embarrassing is this? Okay. So now it comes up and it shows us these are our transactions. Now, the problem with this is everybody over, what do we have, 170,000 members are trying to get into this, so it's slow. What you do is you go into, let's go into an example here, go into one of the different properties, and over here, you will see something called all forms. When you click on all forms, it will talk to you about all the different forms that are out there. We have over 150 standard forms now. I don't know about you, but it's going to be a bit much in my opinion. And if you just put in for a description of the form, we're at the California Association of Realtors, and you put exchange. Oops, wait a minute.
Joel, we can't see the documents that you are sharing.
All right. Yeah, that's one of the problems with Zoom. It doesn't follow my screen. Most of the ones I deal with, GoToMeeting.com and Google Meets, wherever my screen is, you get to go with me. This one says, are you sure you want to take these people to your screen? Yeah, I'm sure. Okay, so here we are. So I just went to an example, and let me know, because I get excited about this and I forget that it's not following me. So I went to zip forms. I went into a transaction. I went over here to Forms Library, California Association of Realtors Library. I just typed the word exchange in here, and here's buyer's intent to exchange and seller's intent to exchange. So I put my property on the market. I'm telling the buyer, you need to be ready to do an exchange. So what we'll do is we'll come over here, move this out of the way, and let's take a look at this form. Okay, this is the buyer's intent to exchange. So what the buyer says is, I want to buy your property. I say, wait, I'm doing a 1031 tax deferred exchange. They say, what does that mean? Well, it's not a problem for you. It just, I have to make sure that IRS knows that was my intent. So this is the form that you would use in there. Buyer's intent to exchange. If it involves a seller, then it would be seller's intent. It's a one-page form, and it just basically says, hi, buyer, don't panic. All I'm going to do is a tax deferred exchange. It's not going to affect you, but in order for it to be a tax deferred exchange, it can't look like I got any of the money. Okay. So we come back to our example. I'll do a new screen share. We'll go back to our example here. And I'll share that. So in our example here, I sold it. I gave them the buyer's exchange agreement. And then they have an intermediary, a qualified intermediary, an accommodator. You say, well, who is that? You can just put the word in the search for accommodator. What I did is I went to my association. I belong to 4 associations because my agents want to belong to these other associations. So I belong to PacWest, Pacific West Association of Realtors, Orange County Realtors, the Realtors Commercial Alliance of Orange County, that we are the only realtor group that is 100% commercial. That's all we do. And then I belong to the elitist boneheads of Newport Beach. That's been my home board for over 30 years. And so I just went to the association. I said, my board, and I said, hey, who do we have? Who is an accommodator that belongs to our association? And I contacted them. I want to deal with somebody who is supporting my association. So they said, okay, here's a qualified intermediary or accommodator. And I said, you know, I've taken classes on this. I've read everything. I don't get it. And I said, Brett, you need to take me to lunch. So we went, actually, I took him to lunch because I'm the one asking the questions. And I said, explain this to me. And so he explained it to me and he gave me some examples like this. Now, this is a delayed exchange timeline. This is delayed. If it is a straight 1031, you don't need an accommodator. But because of how the tax laws are now, you need to make sure, and for what they charge like $1,000. I've got a $250,000 possible tax bill, and they're charging me $1,000 to make sure. That's like $1,000 insurance policy. I'll pay that. I just don't want to, I don't want the IRS to come back and say, no, it didn't work. We're going to charge you. So you have your qualified intermediary, you found it from your association, or somebody said, you know, you join and I belong to other associations, but I don't pay dues for all of them. I just pay their portion of dues. So to belong to the Realtors Commercial Alliance, it costs me $100 a year. And I get all the benefits of CAR, NAR, plus the input from that. So we have a lot of qualified intermediaries that are members of our particular association. So I took them one to lunch, and they give us samples of this because this is mainly investment types of property. You typically aren't doing this in residential. So this is, we have these kinds of people talk to us all the time. So qualified intermediary, they accept the proceeds. So what they do is, there's a buyer. The qualified intermediary owns your property that you're exchanging for 1 second. The money goes in, then they complete the exchange. So within 45 days, you have to identify your replacement property. Now you've heard about the 45-120. So we're going to start with this. We're going to do this a couple more times because again, it's one of those things I was like, what the heck is it? So I put my property on the market. It took me 6 months to sell it. That's not including the 45. Once it's sold, boom, sold. Money goes to the intermediary. Then I got 45 days. And we haven't closed on this deal yet. Okay. The buyer says, I want to buy. The buyer shows, I've got the down payment. I've got this. I'm ready to rock and roll. We got 45 days to get on our pony and ride and find a replacement property that meets certain specifications. Once we find that property, we identify within 45 days, we identify it in writing to the qualified intermediary, the accommodator. So I just write it out. I'm going to buy this property, and I give it to them. We put it in escrow. There's no question. So if I get audited, they say, were you within the 45 days? I say, yes. Date of accepted purchase agreement, date of accepted purchase agreement. Because if I find my property within 45 days, I'm going to buy the horse and thing. That means I'm signing a new purchase agreement. I sold one, I signed as the seller. I buy one, I sign as the buyer. The qualified intermediary transfers the proceeds of the seller to the replacement property. So now I owned it. I sold it to this buyer over here. However, I didn't sell it. I gave the property to the intermediary for 1 second. For that 1 second, the intermediary then sells it to the new buyer and then transfers this new property that I found, within 45 days to me. So it's qualifies as a 1031 tax deferred exchange. You say, Joel, that makes no sense. I understand. We're working with the government here. They're the ones that came up with this horse and stuff. So we stay within their parameters, we're fine. You say, well, what if the 45th day falls on Saturday? Then you have to do it on Friday. What if Friday is a holiday? Then you have to do it on Thursday. What if I don't do it? Then the whole thing's taxable. You have 180 days in which to close the transaction. So I've identified the property. Now I got to close it. So I got to get financing. I got to get, and a lot of times I'm doing environmentals. So I'm doing a phase 1, phase 2. I've got to make sure all the disclosures are done. If I can close within that 6-month period of time, I close. The intermediary who has gotten the title to the property now transfers it to me. I went out and I got the loan. I qualified for the loan. Lenders understand 1031s. It's going to be in the name of, so I sold the property in the name of Joel Carlson. I'm buying the new property in the name of Joel Carlson. I sold the property in the name of MJC Realty Inc. I buy it in the property name MJC Realty Inc. We have to do certain things. And the beauty is the accommodator has a little checklist. They're like a TC, and they have this little checklist, and they say, oh, by the way, y'all need to do this. Uh-oh. If I don't do that and I get audited, bingo, it blows the whole deal up and it's a taxable event. But they got it down now to where it's just, okay, so I put my property on the market, a buyer came along. They say to the intermediary, hi, we're buying Joel's property. I know we're doing a 1031 tax deferred exchange here. I filled out the BEA. Now we go into, I got 45 days to find a piece of property. You say, well, wait a minute. Can I do it ahead of that? Yes. It's just got to be within 45 days. So you put your property on the market, you find a new one. Well, you can't close on the new one until the old one's sold. So, but you identify it within 45 days. If it takes you 60 days, it's not going to qualify. You might as well blow the deal out and start again. So I'm within the 30 days later, I got the property. I go get the financing. I've got 180 days now to close the deal. I get my financing. I do all my inspections, everything. And then boom, the intermediary transfers the proceeds from the sale to the seller for the replacement. So I sold this property. The money went to the intermediary, so it's tax deferred. I then found the property. That money goes to the intermediary. The intermediary gives it to the new seller. I'm a seller. I sold it to this buyer over here. Step 1, we have a new seller, and step probably 4 that we're going to give the money to. Okay? And everybody knows this is a 1031 tax deferred exchange, that there's no liability or animosity or any kind of problems with the buyer, but the IRS needs to make sure it's fallen within the parameters of 1031 tax deferred exchanges. All right. So now, delayed exchange. Most of the properties now are a delayed exchange. If it was just straight across, you wouldn't have half these players. But the IRS has audited several things. As a matter of fact, this all comes from a court case that happened up in Washington, state of Washington. It was with Crown Zellerback, and a seller. He had this wood, trees, and Crown Zellerback said, we want your trees, we want to make paper out of them. He said, terrific, I'll sell them to you, but I don't want to pay tax on it. So Crown Zellerback said, well, we understand you need to get going here. Well, he didn't perform fast enough for them. They needed the paper. They said, here's what we're going to do. We're going to take that money. We're going to put it someplace with an accommodator that you can't touch, an intermediary, qualified intermediary. Then when you find the property you want, the qualified intermediary will put that money in. You never had control of it, so you've qualified as a tax deferred exchange. Well, IRS said, no, there's no such thing as a delayed exchange. We're coming as, it was Starker. His name was Starker. So we call it a Starker exchange back in the 80s. He did it again. And the federal court said, no, that is an exchange. It's just called a delayed exchange. But that moment in time, IRS said, oh, for crying out loud, we're going to put some regulations in here. because otherwise you could wait for years before you completed the exchange. No, they 45, 180. So buyer comes in and buys my property. I'm selling a piece of property. That money goes to the qualified intermediary for 1 second. It just stays in escrow. It's going to go to that qualified intermediary for 1 second. Then it'll go to me, the seller, for 1 second. I then will go ahead and buy the next piece of property, the taxpayer, and then it's direct deeded back to the buyer. So you can see the little arrows here. It goes how this goes. And again, you say, Joel, man, this looks like I'm going around in circles here. You are. Okay. It's the federal government telling you how to do this stuff. So this is what's referred to as a delayed exchange. If you don't close simultaneously, then it's delayed. You got 45 days to identify your next piece of property, 45 days to identify, and then 180 days in which to close it. You say, why do I need so long? Well, you probably don't. If you've done everything within the 45 days, all your inspection, you might close in 50 days, 60 days, but they give you 180 days in which to get it closed. You say, well, what happens if this one falls out? Then it's a taxable event. You said, I'm going to buy this property. If it falls out for whatever reason, you don't buy it, your exchange is going to be taxable. Okay, it has to be identified within 45, and that 45-day period of time is the, if you say, oh no, I didn't do this one, I did this one over here, ain't working. That's why you want a qualified intermediary that knows this stuff, that can document this stuff. So if you do get audited by the IRS, they can say, here's the paperwork, here's what we did. IRS will say, fine and dandy. So let's take a look at this. Identification rules. So you identified one property. That, to me, that's like hard. I'm going to die. But the IRS put up some rules here. And the IRS says, you know what? You can only identify 3 properties. Okay, this is one of their rules. So I have this, I'm selling this $1 million piece of property. I find 3 pieces of property I like. I go into contract on all 3 of them. I don't know how you do this. Actually, what you do is you give the buyer a thing that says 1031. Within 45 days, you're going to pick one of the 3, and then that's the one you're going to go with. But you can identify 3 within that 45-day period of time. And as long as you close on one of the 3, you're good. That's their first rule. This is identification rules. They actually call in the code rules. They say the 3 rules of delayed exchanges. The second rule is 200%. The taxpayer may identify an unlimited number of properties as long as the total market value do not exceed 200% of the property they're relating. Now they always use these words. They're selling. So I'm selling my $2 million property. And here's something I want you to understand. And I just had this guy do this. He had this big property. He wanted to get rid of it. He wanted to do a 1031. Actually, he didn't know what he wanted to do with it. We talked to him about what he's trying to do. He said, I want to get into maybe 3 or 4 other little properties that I can sell one at a time and just pay the taxes on those as I sell them. I said, oh, well, you can take this big property and you can put it in several little properties as long as it equals mortgages and equity. So he went out and got all these mortgages on these little houses in Phoenix that were equal to or greater than his existing mortgage on the property he had in Beverly Hills. He then took the money out of the sale of that property and he made it the down payment on those little properties. So you could go from one big property into several little properties. You could go from several little properties into one big property. You could go from a 500 apartment buildings and exchange it into raw land as long as you're equal to or greater than in mortgages and equity. Getting the hang of this? So in this particular instance, the taxpayer can identify any number. So he identified maybe 20 little houses, but he's got to close on 200%. So he sold the one property for $6 million. That means his identified of those little houses could not add up to more than $6 million. Well, that ain't hard. Okay, so you could go the 200% rule. You say, Joel, why can't I just do the 3? I'm just telling you this is what the rules are. I always do the 3. I can't keep track of the 200%. I can't keep track of the 9. Look at this 95. If the taxpayer identifies properties in excess of both of the above rules, I identified 10 properties more than 200%, then you must close on 95% of them. What? So now I'm getting rid of my $6 million or $100 million piece of property, and I identify 5 properties that are over 200% of that $1 million property. So it's maybe $10 million. I have to close on 95% of the 10 million. That's, 95% of 10 million, $9.5 million worth of properties out of everything I've identified. I've never seen a 200% or a 95%, never seen them. It's always the 3 properties. We go out and find 3 properties, we identify them, we write contracts on them, everybody's ready to go. We give it to the accommodator, and then we pick one. It's usually how it works out. So the 3 property rule. So here's option number 1. You could identify 3, option 1, 2, and 3. I say, oh, well, it all depends on what happens here. Now, I know you say to me, wait a minute, let me get this straight. I'm selling my $1 million property. I'm exchanging it for another piece of property equal to or greater than $1 million in equity and loans. But I'm going to do that 3 times. What seller in their right mind would let me tie up their property as one of the 3, not knowing whether or not I'm going to pick it? Well, you just tell them it's a 1031 tax deferred exchange. Typically what they do, they say, fine. The price was this. Since you're going to drag my property around for 45 days, I want a little bit more money. We'll cooperate with you. We'll let it be one of the 3 in that 45 period of time. But if you don't close on it, we're going to get some money. Okay. However you work it out. And you could give them money up front. You could give them money at the end. However you want to work it out, it just has to be identified. That's the property. That's the address. You give it to your accommodator. You make sure that it's equal to or greater than in mortgages and equity. So I have $1 million piece of property. I owe $500,000. I'm going to go into 3 different properties that are more than $1 million that have loans on them at $500,000 or more. Once I figure out which one I'm going to do, I close on that one. Versus the 200% rule. So the 200% rule says I got 100% in here. I got to go 200% here. So I got 2 units here. I got to go to 4 units, 4 monetary units. So if each one of these is 100,000, that's 100,000, 100,000, 200,000. I got to go into something that's 400,000 maximum. So I could identify 20 properties, but it can't be more than 400,000 if I'm getting rid of $1 million. Okay. Or sorry, 100,000. Let's do $1 million. So I'm getting rid of my $1 million piece of property. I want to do the 200% rule. I got 5 properties I want to identify. Those 5 properties cannot add up to more than $2 million. I'm selling my $1 million. I identify 5 properties. They can't add up to more than $2 million, 200% of what I'm going out of. Say, Joel, I hope you're passing out the brownies after this, because I ain't getting it. I'm with you. Here's what you do. You see what's going on here. Then when you sit down with your tax person or you sit down with your accommodator, they say it again. Remember, I'm going to tell you what I'm going to tell you. Then I'm going to tell you. Then I'm going to tell you what I told you. If it were simple, everybody would do it. It ain't simple. Okay. Once you've done a few, it's like, why didn't I do this all along? But the first one is always one of those, does this really work? Now, 95% rule. So the 95% rule says it's worth $1 million. If I go 10 little houses here, those houses have to be at least, I have to close on at least 95%. So I'm getting out of $1 million building and I'm going into 10, $1 million. I have to close on all 10 of those, or at least 9.5 million. And that's why it's like, how do you figure this out? I'm telling you, IRS, when they put this together, just wanted to make noise out there in the real world. I don't know of anybody doing this. I know it's been done, but I've never even come close to this. I've never even come close to this. It's typically this. Let me make sure you're seeing what I'm seeing here. No, you're not. Boy, this is a piece of grunt, isn't it? All right. So option number 1, option number 2, apologize about that. And let me see, is there anything in here? Nobody's put anything in the chat. Okay, so.
Wait, Joel?
Did the,
Joel,
yes.
I think that Maria has a question because she sent it to me privately by mistake. She's asking for
Okay.
timeframes for each move for sell or buy.
Okay, it's 45 days. So we have the 45-day identification period. So I put the property on the market. Today, the property sells tomorrow. But let's suppose it was a normal market. It took 6 months to sell, or whatever normal is, okay? That's not includes the time period for identification. It's once you have a buyer, the buyer signed the contract, we've opened up escrow. Now you've got 45 days in which to identify the next piece of property. And you've got 3 ways in which you can identify. Once you've identified those 3 within the 45, you got a total of 80 days to close. So including the 45, 180 days to close. You can do your and a lot of time what it takes is you're doing your environmentals, your phase 1, phase 2. Okay, that's what takes the time, and appraisals, and then you got to get the loan and things like that. So in that particular case, there are 3 rules you have to follow. I got a buyer, I put my property up for sale, and a buyer comes in, we sign a contract. It goes into escrow. I got 45 days to do one of these 3 things. So one of these 3 things, I can either identify 3 properties, 200% or 95% rule. So here's the examples. Let me make sure it's showing you what I'm showing you. Good, okay. So the 3 examples, I'm not going to do all 3. I could do all 3, but typically I'm going to do a 1031 tax deferred exchange to one of the options. And this is the ones that I've always done, the 3 property rule. Very seldom can I go to the next one that talks about the 2 property at 200%. In other words, I can identify any number. I can identify, I'm selling 1 property, I can identify 10, but I got to close that those 10 cannot add up to, this cannot add up to more than 200% of what this is. You say, I don't get that. I'm with you. I'm just telling you what the rules are. All I want you to do is when you're in the middle of a 1031 tax deferred exchange, or when your buyer or your seller says, you know what, I'm thinking about this, you can say, you know what, I've had a class on this. I know just enough to be dangerous. And the dangerous part is we need an accommodator. And I've dealt with several different accommodators. And, you know, this is what they do for a living. And they only charge you like $700, $1,000. And they do all of this for you. And they give you all the timelines and keep you on track. It's like an amazing amount of work for what they get paid. So this is the 200% rule. Then the 95% rule says I can identify any number I want, any amount that I want. Doesn't have to be 200% of what I'm selling. I just have to close on 95% of them. So my example was I sold this one for $1 million. I identified 10 pieces of property that are worth $1 million a piece. I have to close on 95% of those. Otherwise, I can only identify 3 for the 3 property rule, or I can identify any number as long as it didn't add up to more than $2 million. I'm getting out of my 1 million. I'm going into 2 million. Say, Joel, I hear what you're saying, man, but I ain't with you. I know, but I'm going to tell you over and over and over again, and then you're going to look at this and you're going to go to CAR and you're going to get the 30 questions on 1031s, and then you're going to probably take a couple more classes just like I did. And then you'll do your first one and you'll go, I don't believe it. Are you kidding me? No tax, plus to get all these benefits? How do I get involved? And that's exactly what I did. I was 26 years old. I got my real estate license 2 years before I did my first 1031 tax deferred exchange, and it was like, I wasn't involved. I did it for an investor. And I was like, I want that. I want to do this. And that's what I based most of my real estate career on. Is invest in not selling anything. You know, and I look back on what I've sold and I go, you dummy. You should have never sold that, paid the tax on it, even if you had the write-offs, because what has real estate values done in the last 30 years in Southern California? Done nothing but go up. It's the learning curve. It's steep sometimes. All right. So a reverse exchange. Now, do we need a break? Let me see. If we need a break, we can take a break, because now we're going to get into something that's like you need the magic brownies to get into. But I have this happen to me at least once a year. So if we need a break, let's see. Somebody say Yes or no in the chat. Yes, we need a break. Dad, come on, take a 5-minute break. Move on. Or no, Joel, I don't know what you're talking about. Okay, no. So we'll go ahead and we'll keep going. Fine. Perfect. I love it. That way we can get out early. Instead of 4 o'clock, we'll be out at 3. Joking. All right. So now we got a reverse exchange. You're in a market that's very hot right now. You got an investor. He sees a piece of property, goes, bingo, bango, bongo. I want that property. He's got the cash or she's got the cash. So what they do is they give that cash to the accommodator. The accommodator buys the property they're looking at. Then they put the property on the market they're trying to sell to create the 1031. So if you acquire a replacement property before selling the exchange property, it's called a reverse exchange. You say, well, how do I do that? I've got investors, they got a lot of cash, but the deals, they don't come up very often. And when they come up, you have to bingo, you buy them. So just did one in, well, it's in New York. It's in Manhattan. The deal came up. It was part of the PRC, half the PRC, People's Republic of China, who owns a lot of real estate in the United States, wanted to sell half of their interest. I had a trust fund. Actually, it was a REIT, real estate investment trust. They wanted to buy it. The seller said, I need the money now. The buyer said, I have it. So what they did is they gave the money to the accommodator. And I know this is like, you did what? You don't even know who these people are. They're insured, they're backed. They do this all the time. So they're not going to run off with your money. Now the first ones did. There's a couple of court cases where they gave the money in a reverse, and the accommodator looked at this and went, hoo-hoo, bye, and they disappeared. One disappeared. The last they could track, they tracked them to Hawaii. The other ones, they went across the Mexican border, and they were each more than $10 million each. So in this particular case, you go and you buy the property. I'm the buyer, I'm buying this property, but I give the money to the accommodator, all the cash. Let's suppose it's $1 million. This deal comes up. If I don't buy it right now, it'll be sold to somebody else and I won't get the deal. So I've got the cash, I buy it. I give the cash to the accommodator buys it. It's in my name for tax purposes. Then I was going to do an exchange, but I haven't even put the exchange property on the market yet. So now the accommodator has this property, they paid for it all cash. I then put my other property on the market. A buyer comes along, buys it, and they cooperate in a 1031 tax deferred exchange. They get my property for 1 second, then they get their property, and the accommodator gives me my property, and it works as a reverse exchange. So you hear this. So it says the property must be transferred to an accommodator, a qualified intermediary. And the qualified exchange, again, must be within 45 days and close within the 180. You say, whoa, wait a minute. We already got the property. We don't need 45 days. I understand. This is the IRS we're talking here, okay? The IRS says, yes, you gave the money to the accommodator. Yes, the accommodator bought the property. Yes, you're selling this piece of property. You just have to do it within 45 days. You've done this. You want this one to qualify? You got to put your property on the market. You got to get a buyer within the 45 days period of time. Okay, well, it's a hot market. We don't have any trouble with that. Then you have to close on this one. This one's going to stick around for a while until such time as you get this one sold. You sell this one. The buyer takes title to this one for 1 second, and then boom, you do the exchange. And that's why you need the piece of paper that says the buyer will cooperate in the 1031, because the buyer for 1 second is going to take that property over. Now, when I heard this, my question was, if the buyer's in the chain of title, could they be liable under the good funds law? That means they have to clean up any toxic waste problems. The answer used to be yes. They are now exempted. IRS has taken the position they are not liable. They're not in the chain of title for that problem. Okay, so the accommodator buys it. They're owning the property, and they get all the benefits out of that property until you close the new one. So they bought the property for you. I put this property on the market, I sell it. I then do the 1031 tax for exchange. So everything is the same. The accommodator just owns the property prior to my putting this one on the market and selling it. All right, let's go down here. So timeline for the reverse exchange. Purchase replacement property. Property is held by the accommodator. And when this law first came about, I was like, the accommodator has no, they just take the money and run or never transfer it. No, they've got it down now. It's very succinct. It's backed. Once this whole thing starts, it cannot quit. If you don't identify within the 45 days, then you're going to be taxed. If you don't close within the 180 days, then the profits from this are going to be taxed, but it will automatically come into your name. I gave the money to the accommodator. They bought the property. It will automatically come to my name within 45 days because I gave them the money. They don't own the property. I own it, but I couldn't find a replacement property. I'm still going to get the property. I'm just not going to qualify for the 1031. You say, well, what happens then? What happens then is $250,000 in taxes. That's what happens. And that's when your client goes, I don't want to pay that. Good, I understand. Why would you use this again? Because we're in a hot market. A 10-unit apartment building comes up, it's gone. So I've got cash, I'm ready to go. I find the property, I get the accommodator, I say, lock this puppy up. Then I take my other 5-unit building, I put it on the market, it sells, and we complete the 1031 tax deferred exchange, and it qualifies. That's the only reason you do it ahead of time. Okay. You say, well, I got to have the cash to do this. Yeah, but I don't have the cash. Then you can't do a reverse exchange. Okay. Certain things you can do, certain things you can't do. So, I'm just telling you, this is out there. And in this particular market, I've had 2 in the last year go, are you kidding me? Price of property is going up like this. I'm going to give the money to the accommodator. When we find the deal, we're going to get it. Then I'll put my other property on the market and sell it. And we'll make sure the exchange works under 1031. And we don't have to pay the $250,000 in taxes. All right. So one of the major benefits in 1031 is you can take the tax deferment to your grave. Okay. So it says, the inherited property received through 1031, it gets a step up in fair market value. And that's why I say, what I did is I bought my first little home in Riverside. I held it for 2 or 3 years. The rents went up. I put it back in the market 1031 for a duplex in Riverside. I couldn't find anything in Orange County. I then fixed that up, increased the rents, and went into a 10-unit. Okay. Now I'm into what are called net lease properties, and that means the tenants. These are commercial properties that the tenants pay the property taxes, the insurance, and the maintenance. You say, what? That's what I said when I heard about it. I was in an accountant's office up in Beverly Hills. He said, Joel, blah, 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 net lease properties. Now, sometimes you hear referred to as triple net. That's a misnomer. And the reason is because if that's a triple, what's a double net? There's 3 things in a net lease. The tenants pay for the property taxes on the property, the insurance on the property, and the maintenance on the property. Why would they do that? I don't have a clue. We do it all the time. As a matter of fact, your favorite Starbucks, they don't own their building. They rent it. They lease it. And the owner of that, the Starbucks, takes care of the building, takes care of the property taxes, takes care of the insurance on it, and sends the owner of the building a net check. That's why they call it a net lease. Out of that net lease, you pay your mortgage. You say, Joel, I don't have a mortgage. Then you put it in your pocket and go have fun. So those are basically what I'm tired of tenants. Okay, especially now we got COVID and we got all these new laws and regs in the state of California. I don't have the commercial. They don't have these rules and regs. And if Starbucks goes out of business, it's guaranteed by the corporate office. So they're not going out of business. Okay? And if they do, we got bigger problems than just them going out of business. So so whatever I have upon my demise, the kids are going to get these properties. The minute they get these properties, whether they're in a trust, whether they're individual, however they get them, through my will or through my trust, they get an automatic step up in basis to fair market value. So let's suppose the fair market value is $10 million. They get it. They could put it on the market and sell it tomorrow. What's their basis? $10 million. What'd they sell it for? $10 million. How much tax do they pay? Zero. Are you getting the hang of this stuff yet? Who put this together? Congress put this together. Why? Because congressmen made most of their money in real estate and they don't want to pay taxes. Okay. I'm just telling you, you do the research on it, you'll see this. So this means if you die without having sold the property, you obtain a 1031, the heirs receive a step-up market, all deferred taxes are erased. Remember the $250,000 on the first example? If I sold that property, 10 days later, a year later, 50 years later, if I sold it, I would have to pay the tax and any depreciation I've taken. If it goes to my heirs, or errors, as the case may be, there's no taxation to them. Now, they're looking at, I'll tell you right now, Congress is going, we're putting out a lot of money and the printing presses are getting kind of worn out. We need to tax the people more. So they're looking at this as one of the ways in which to make more money. You will not be able to sell and do a 1031 exchange the way you have in the past. So I don't know, at this moment in time, I think it's good for the next 5 years. It'll take them that long to fiddle around with it, but they're going to make changes to it. And I think one of those changes, just like Prop 19, you die, the property goes to your son, your daughter, your grandson, daughter. They don't get their old tax benefit anymore, the property taxes. It gets a step up unless they live there. I think they're going to try and do the same thing here. So just be ready. All right. Do we have any questions here? Let me make sure you're looking at the same thing I'm looking at. Good. Okay. Good. Comments? All right. So now, tax deferred exchanges, questions. We need some good questions here. All right. Now, here's what I'm going to do. I'm going to go back here to my share screen. I'm going to go back to this example. Okay. So $1 million piece of property, the value of the land, and this is the building value. Out of $1 million piece of property, 700,000 is building value. You can depreciate that over a 27.5 period of time. That's apartments. I should put apartments. Residential. Actually, the law said residential. So I guess you can have apartments that are commercial. If it is commercial, then it's 39 years depreciation. You say, I don't know where they came up with these. I already told you that. If we just take the apartment and we divide that by the $1 million, we divide it by 27.5, that comes out to 25, 4 and some change. That means, here's what it basically means. Depreciation means your property will fall to dust in 27.5 years. No, it won't. It'll go up in value about 10 times. But that's the idea behind depreciation. It's lost its usable value. You need to build a new property. Like, right or wrong, that's just what they do. So if I made AGI fund $25,400, that was my income. I made $100,000, had $75,000 worth of business write-offs. That means I'd be taxed on $25,000 because I own this one piece of property that's worth $1 million. And it's $700,000 is the value of the building. I get to depreciate that over 27.5 years. This is commercial, so let's make sure we put commercial. 27.5 years. That means that I don't have to pay tax on $25,000 of my income. So what I do is I did some estate planning on my own. I said, then what I need to do is I need to have this many properties that have this amount, that are break even. principal, interest, tax, insurance, maintenance, management, association dues, any other things are paid for by the tenants. The rent comes in, that money goes out. I have no income from the property. It's a break even. I have to have reserves. Now, this is one of those things. If you belong to a condominium project, you know, the air conditioners go out, the heaters go out. So you got to take some of that money, put it in reserves so that you don't take it out of your pocket. I know a lot of investors that have their reserves as their credit card. Well, that's pretty expensive in my opinion. So I'm not really interested in doing that. So all of that is a break even. Then my only benefit from owning the property is the write-offs on a yearly basis and the appreciation over when I sell it. You say, why get appreciation every month? You get appreciation when you sell. You don't get appreciation every month. You have to sell in order to realize that. When I have a piece of investment property, I get the write-offs. That's on a yearly basis. So that's what I look at, depreciation. And I ain't never going to get rid of the properties. I'm going to pull the ultimate tax coup and I'm going to die. And it's going to go to my heirs, or as I told you, heirs, the case may be, and they're going to get a step. Now, if they want to sell it and buy that condo on Mars, they can do that. We'll be in Mars by then, I think. Okay. So of the $250,000 that I would pay in tax, and this is the one thing that said, wait a minute, let me get this straight. I don't pay that $250,000 in tax in our example. That means if I could use that $250,000 as more down payment, and just suppose it was 30%, I could buy another $833,000 worth of real estate. Take 70% of that, divide it by 27 and a half years. That's more write-off. You should have paid $250,000 in tax because you sold it. You didn't. You 1031. You now get to buy more real estate. You get the appreciation, depreciation, income. You say, I don't need very many of these, Joels, before I can say, forget about this whole thing. That's why I'm doing this class. That's why I told you, this is my favorite class. This is the class that I went, are you kidding me? I would do it every dadgum day if I could, just because of the benefits involved here. All right, so questions. I got 19 of you left. The 23 that started out, 19 have stuck around and said, okay, there's something here. I don't know exactly what it is, but I'm going to hang on until the very bitter end just to make sure I've got a feel for it. All right, let me make sure. So I talked to you about the forms that you would use. You say, well, what are the exchange forms? It's a regular purchase agreement. You're selling your investment property, so that's an RIPA, residential income purchase agreement. That's what the buyer signs. But the addendum is the buyer is going to cooperate in a 1031 exchange. And then your accommodator will handle everything from there. And your escrow company, who understands 1031 tax deferred exchange, will make sure that the verbiage is proper and that you do the 45-day identification and you close within 180 days. If you're doing a reverse exchange, same. You buy the property all cash by using an accommodator. That always made me nervous. I was always like, but now they've got it locked down, insurance policies and all sorts of different kinds of things, irrevocable bank accounts or something like that. They buy the property for me. I then can put my property on the market and sell it, take those proceeds, put it back into the property the accommodator bought for me because I got a deal. You know, I'm telling you, sometimes I get a situation, I look at this, I go, and I don't have the cash to buy it. So I'll call up my investors. Hey, you want to buy this? They say, heck yes. But we got another property we want to get rid of. I say, okay. And they get rid of that one. And they do a reverse exchange. Now, I don't have any questions on this at this moment in time, but I'm going to go to something else now that goes along with this. But it's one of those things that when I discovered it, it was like, what? Let's suppose you sell a $1 million home. You make a 2% commission on it. So 2% of 1 million, or let's suppose you make 1.5%. You got to split it with your broker, whatever else happens here. So $1 million piece of property. If you're having trouble with that, it's, 10,000 bucks here. Let's go. Times 0.0. It's on $1 million piece of property, $15,000. All right. So I'm getting that $15,000. I sold this deal. I'm done. On an investment property, the seller comes to me and says, "Hi, Joel, I want you to sell my property." Oh, okay. I made $15,000. They say, "However, I want to do a 1031 tax deferred exchange and I need you to represent me on the buy side." So we buy another piece of property. I sold one for $1 million. I made $15,000. I put them into another one for $2 million. I just made $30,000. If I just take 1.5%. Now, by the way, if there's anybody here from the Federal Trade Commission, I'm merely using 1.5% as an example for the class. Okay, I'm not trying to price fix. Let me see. I made 15 plus 30. I got both ends of the deal. Every exchange I do, I get 2 commissions. Is it starting to sound a little juicy now? When that first hit me, the first time I did one, I said, whoa, wait a minute. I got a commission for the seller. What's this for? Oh, do you represent him as a buyer? I said, this is the dream. I'm a dual agent without being a dual agent. And it's legal anywhere in the United States. This was one of those things where it's just like, come on. Not only are the benefits unbelievable, but now I'm getting paid for both ends of the deal. And that was like, I got to do more of these. And that's why I've pushed, that's why I do mainly investment properties. You know, if somebody says, well, I want to sell my $4 million home, I'm not going to kick. But I know I like investment properties because there's so much benefits to go out there. So we did the 1 million on your commission on that. If it was just 1.2% or 1.5%, that equaled 15,000. That's what you get for being the listing agent. Then you're the buyer's agent for it's got to be equal to or greater than in mortgages and equity. So that means it's got to be more. Let's suppose it's just a 1.5 million more, not double. Typically it will be, just to let you know. I don't know how that works out, but just to let you know. And I get 1.5 of that. Now what am I at? 30,000. I'm a product of the LA City School District. That means I cannot add, subtract, multiply, divide, or spell. So got to have my calculator. For one deal, you made 37,500 bucks. Not 15,000, 37, because you get both ends. I'm telling you, whatever you have to do, if you say, okay, Joel, I went to your class, that was nice, I'm going to sell houses, I'm happy. Perfect. If you say, Joel, there's something here, I got to then get involved. Make sure that you're pushing some of your time to learning more about this and telling everybody you know. Have you ever thought about a 1031? What the heck is that? Let me tell you about it. And the more you tell them, the more knowledge you have, the better you'll feel about it. And when you first put your first one together, it's going to be like, come on down. The sale commission pays the bills. The buy commission, that buys the new car. So this is why it took me years to get this under my head. And that's all I do. All right. So any questions, comments, reactions on what we've covered? You say, Joel, my head is spinning. I think this is wonderful. I don't have a clue what you just talked about. Okay, I know. Let me go ahead and
Joel, yes, we do have a couple questions.
Good.
Okay. Actually, they're wondering if you could provide names of a few accommodators and also recommendations of a few real estate CPAs.
The CPAs are tougher. The person I use is Carla Dennis. She's out of La Palma. Carla Dennis, she's been my CPA for almost 20 years, and She's got her, I don't know that she's taking on any new people because she's a television personality, she's a radio personality, and she does all sorts of lectures all over. But and I always say, hi, you were recommended by me. They say, you know, I got too much business, I can't take you on. Good, who do you know? Because they will only refer you to people they're comfortable with. So Carla Dennis for a CPA, as far as 1031 tax versus accommodators. And remember, accommodators can be called intermediaries also. So you're looking for intermediaries. First thing I would do is look in my association. You've got to have at least 2 or 3 that are affiliate members. And you say, well, yeah, but you don't know if they're any good. Okay, I'm with you on that. So there's asset preservation. Probably should write this down here. Let me go to my other page here. Okay, share screen. Good. There. Move this up a little bit. Asset preservation. Asset preservation, crud. The person you want to talk to is Dino Champagne. Dealt with Dino for 1,000 years, it feels like. Preservation. You see, go to Dino here. And then CPAs, that's another one of those. So best number to reach her at, tell her Joel sent you, otherwise she'll be mad I gave this out. And she does these also. She does these 1031s, and she
Talks about it from an accommodator's point of view. So you say, well, what X does accommodators do? What are the? She gives it to you from that point of view. Let me see. Asset preservation. Asset preservation. Let's see. And then, well, I just blanked on the other one I was talking about. I'll think of it in a minute here. This is an accommodator. And then escrow company, the escrow company that I use in Newport Beach is Coast to Coast Escrow, Brenda, Coast to Coast. And she does commercial types of deals all the time. So she's familiar with 1031s, Coast to Coast. And before I went to anybody new, I would always contact the people that I'm using currently and say, hi, I went through a class. My mind is still blown. Do you know what he's talking about? They say, oh yeah, we do those all the time. Perfect. I would go with them. Coast to Coast. Another one that escrow. Another one I use on a consistent basis is Freedom. And most of these are located in Newport Beach, Freedom Escrow, just because that's where I am. As far as accountants, Carla Dennis, and I said, I asked her to do a favor for me, and she said, I'm too busy, Joel. You'll have to ask somebody else to do it. I was like, what? I've been a customer for all these years. So Carla Dennis, she's a CPA, and she's in Oklahoma. And she used to be a little closer to me, but she moved there, and she's got this whole building, and it's unbelievable. Anyway, CPA, certified public accountant in La Palma. Any other questions? And I'm going to try and look up these accommodators here. Oh, John Lastalik. Yeah. So here's another one. John is, I think he's been in this business as long as, and he's with Haven. John Lastalik. He's the kind of guy, he'll pay for lunch to take you out and tell you about it rather than you get to ask him. I'll tell him I told you. All right, Lastalik. Now, you know, things change, and the COVID has put a lot of change on a lot of different people. So if they say, well, I don't do this anymore, or that, tell them, okay, fine, I understand. Who do you know? You get a referral out of them. All right, good. Any other questions? Comments, reaction. Okay, so who's gonna do this? Raise your hands. All right, that's what I want to see. I'm gonna check back on you. I got your names and numbers. I'm coming to see you. Because if you do this, you can take that job and shove it. You can pretty much write your own ticket. Okay, good. So you got my information here. Let me put it up there one more time so that if you want to get in touch with me, it's always amazing to me the amount of people who will contact me after I probably talk to over 3,000 people a year in my seminars. I'll get one or two that'll call me, one or two that'll email me. So I'm not worried. Oh God, you give this out, Joel? Everybody, no, they won't call. They won't email. They'll just say, well, it was wonderful and I was well, entertained, but nothing. You're certainly welcome. Happy to have you all here. Again, if you have any other questions, feel free to get in touch with me. If you have any answers, sometimes you say, Joel, I just learned something. Let me know about that too. I'm a lifetime learner. I take classes all the time. All right. Again, thank you very much for being here. I'll see you, as Robert Ringer says in his famous book, Winning Through Intimidation. I'll see you in the jungle. Aloha.
Thank you, Joel.
You're welcome. Thank you for being here.